And what were the big stories in the markets this week from your point of view?
So look, I think it was big tech earnings. I was out marketing, seeing clients this week. I couldn't get out of a meeting without having a debate over a certain company. And then also I think Jackson Hole was the other one. And I would say, look, with Jackson Hole, I don't think there were any big surprises there, but I do think it was good to get that event out of the way.
What about Jackson Hole from your perspective, Scott? Did you hear anything that surprised you, anything that might change where the markets are headed?
Well, I think what Chairman Powell gave us was a continuation of an ongoing theme that he's going to stay the course on his focus on inflation and wants to see the path to 2% very clearly. In the meantime, I think the question that continues to come up with many clients and investors is, so how do I think about interest rates breaking through 10% on the 10-year and moving through 4.2% or higher? And so there the discussion very quickly goes from, okay, we get it. Fed funds probably higher for longer. How do I think about longer-term interest rate trends, and how does that affect the valuation paradigm on U.S. equities?
Scott, I think one of the things we heard from Jay Powell on Friday was we're not sure where we're going. We're, as they say, data dependent. It depends on how the numbers come in. So what do you advise clients if, on the one hand, it's 4.5% yield on the 10-year versus 3.5%? I mean, that's 1%, but it could make a real difference in the value of stocks.
Right. So the easy answer for me is that we look for pullbacks to be more opportunistic, getting long U.S. equities, going into a fairly robust target for the end of this year at 4,600 and our mid-year target for next year, 5,000. So we're looking at any market pullback as a function of valuation compression around the rate discussion as ultimately a buying opportunity. As we think under the surface, the S&P 500 is probably less connected to the aggregate U.S. economy than most expect. And in that regard, earnings become a more important driver. And there we're table pounding bullish in terms of how corporate America is contending with the macro influences right now.
Lori, we have a rare opportunity here tonight because we have not one but two Bloomberg gals present in you and Scott. And he just mentioned he's at 4,600 year end this year. You're at 4,250, right? And the 4,300 is the median. Is there much difference between that 4,600 and the 4,250? And what might push you to the lower number?
So we're basically at the median right now, and that's also basically the average of 6 different models that we run. And our most bullish model gets us up to 4,800 on the S&P. That's looking at where we think valuations could be and our earnings forecast. But the real drag on our model, I would say, is actually our cross-asset indicators, which look at stocks relative to bonds. Now, that was a reason to be bearish at the beginning of the year, but we did see some improvement on those models in the second quarter. What we've seen recently with this move up in bond yields is that those models are rapidly getting more or less favorable for equities, more of a pressure point, and we are actually starting to see money flows come out of the U.S. equity market as well.
That was just my question, because you've always, Lori, been telling us, you know, we really need to be in equities. People are underrating equities. But are you starting to see flows? It is substantial right now as the bonds become more attractive with those yields.
So what's interesting is that to start the year, everyone said, okay, bonds are more attractive than equities, and we did see money flow go into bonds. And then we actually saw in the second quarter money come back into U.S. equities as it was being pulled out of Europe. So there was an international dynamic that helped the U.S. equity market. But what we are seeing now is that we're getting to a point in the year where these flow trends tend to fade a bit. You're seeing those European equity flows stabilize, and that money is actually coming specifically out of the growth part of the market, and that's pulling the overall U.S. equity flows down.
Scott, one of the things that may keep people into equities is earnings. Where are you on earnings right now? What do you think about the season we've just been through, and what are you looking at in 2024?
So the change with Q2 earnings was that in comparison to Q1, we saw earnings for the full year move higher post Q1, but you didn't see too much in the out quarter side of the equation. With Q2, we began to see an upward revision bias to Q3 and Q4. We think at this point the 23 earnings at around 220 are more or less dialed in, but where we think this is headed is that as we work through either economic slowing or mild recession, the path is still for higher earnings as we move into 2024. And we're on the more bullish side of the outlook for 2024, looking for roughly 245 of earnings. There are some sector differences in here that influence the way this year versus next year play out. And so we're looking for a, let's call it less dispersed sector setup as an underlying driver of a earnings acceleration into 2024.
Laura, do you see some sector differences as you look into 2024?
So what we've seen for next year is that if you look at the change in the anticipated growth rates on earnings, I believe it's healthcare and energy are the two that have actually seen some upward revisions recently to that year specifically, and those have actually been two of the better performing sectors in August in the U.S. equity market for the S&P specifically. So you are seeing investors pay attention to that kind of issue. I think the other thing, though, to keep in the back of your mind on 2024 earnings is that inflation is anticipated to moderate. I think this will affect energy and healthcare less, but as that happens, our model actually shows it's a drag on revenue. So we think there could be some earnings pressures people need to get prepared for.
Inflation may moderate, but we heard Scott say there may be a slowdown or even a recession in 2024. That's still a possibility. Do you think earnings will hold up in that situation?
I think there are a lot of cross currents, but we have found that revenues in S&P earnings are really dictated by two things: inflation and GDP trends. So I do think it will be tough if we do see, sort of the recession just pushed into 2024. I think that ends up being another challenge to earnings that's hard to get around.
Scott, how much attention do you pay to the GDP? Because you know the GDP numbers coming in, some of the numbers are really extraordinary, 4-5+% at this point. Do you believe those numbers, and how much does that affect your advice?
So I think that the correlation of earnings to GDP is certainly high and an important element. I think we have to look at correlation alongside leverage or beta to GDP. And there I'd be a little bit differentiated in terms of the way we break the S&P down. It's essentially into three clusters: growth, cyclicals, and defensives. Our growth cluster is roughly 40% of the S&P. So almost by definition, it should be less economic sensitive. Defensives, we know, are defensive for a reason. They're less economic sensitive. So that leaves your 30% of the market that we characterize as cyclicals that ought to be more exposed and leveraged to GDP. When you pull all of this together into our modeling, the result is that you actually set up, we think, for a mean reversion higher on some of the more economic sensitive side sectors of the market. This would include energy, to Lori's point, financials. I think you even throw materials in there. We think the cross currents are setting up here, and it aligns with what Chairman Powell mentioned today. Basically, what he was saying is that we're seeing signs of interest rate effect and Fed policy effect on roughly half of the PCE. It's that non-housing services component that's stubborn. But what this sets up for is actually a mean reversion higher on the economic sensitive side going into next year.